Bitcoin's recent soft patch isn't just a price story, it's a macro and sentiment narrative playing out in real time. Across crypto markets today, Bitcoin has been under pressure, sliding amid a broader shift in risk sentiment and fresh economic data that dim median expectations for near-term rate cuts. The sharp revision to U.S. labor data, including the realization that nearly 1 million jobs from last year never existed, knocked confidence and effectively eliminated a key catalyst that traders had pinned on future rate easing. This weakness hasn't been isolated to crypto. U.S. equity markets reacted to a delayed January jobs report, with major indexes such as the Dow and Nasdaq drifting lower, while the S&P 500 hovered flat. The mixed response indicates investors are beginning to price in a more uncertain economic landscape, where strong employment data reduces the odds of immediate Federal Reserve rate cuts. For Bitcoin specifically, this backdrop matters because crypto remains highly correlated with broader risk assets, especially when macro conditions tighten. The absence of a clear rate pivot, combined with labor data revisions, has removed a core bullish narrative that had supported reflation trades across risk markets. As a result, speculative capital is pulled back and trading flows have softened. Technically, BTC's slide below key psychological levels has reinforced short-term risk aversion, but the market structure hasn't broken. There is still evidence of on-chain support from holders who are not capitulating en masse, and the network's fundamentals remain intact despite price volatility. What's clear from today's data is that markets are repricing risk on multiple fronts. Crypto is sensitive to macro signals that affect liquidity and carry. Stocks are digesting labor data that may delay monetary easing, and risk-off sentiment is broadly influencing both equities and digital assets. In this environment, short-term price moves are being driven more by positioning and expectations around monetary policy than by changes to underlying fundamentals. If labor data and economic indicators continue to surprise to the upside, risk assets, including Bitcoin, could be pressured further until new catalysts emerge.